Let's now get a foreign investor perspective of the Asia markets, India in particular, and we've got Toby Nangle, who's head of multi-assets at Threadneedle Investment Services, who joins us on the show from London. Toby, to begin with, you had stated earlier in March that the money injected through the second LTRO would be positive for risky assets. Which asset class do you believe will benefit the most from this? Do you believe it's going to be emerging market equities, or do you believe it's going to be developed market equities, maybe currencies, even commodities?
We thought that the second LTRO would be a net positive because it took away the prospect of immediate financial failure of a variety of banks in Europe. So we weren't thinking that it was a great way of going and buying European equities or indeed any development market equity per se. But that said, we did think there'd be overspill into US equities, and we've maintained an overweight there. And increasingly, it's starting to look like that will also help the global growth picture, and emerging equities are a good way of taking that.
There was a big rally in emerging markets in the first quarter of calendar year 12, and we're now in a consolidation phase. Is the view that 2012 would be a year of good returns for emerging market equities versus the developed market equities?
If you take overall developed market equities, there's a lot of Europe and there's a lot of Japan. There's a certain amount of US that we like, but overall, given the higher equity risk premia on the table for emerging market equities, in a choppy year, we think emerging markets will outperform developed markets.
Now, Toby, just focusing on emerging markets sovereign debt, is it drawing interest in multi-asset portfolios like the one you manage?
For quite a while, we've looked at emerging market debt. If you like, there are two sorts of emerging market debt. There's the hard currency denominated and local currency denominated, and they're quite different animals. On the hard currency side, so that's dollar-denominated emerging market debt, that looks quite attractive versus some of the other credit out there, so versus corporates, and we've been allocating from high-grade corporate to emerging market debt. And on the local currency side, the overwhelming driver of that is going to be EM, foreign exchange. Now, after last August, September, you had a big blow to EM FX, particularly, I mean, that's continued in India. But we think that actually emerging market foreign exchange looks attractive now. So we actually quite like emerging market debt from both the hard currency and the local currency side now.
And Toby, what's your view or assessment of sovereign bonds for economies with high fiscal deficits such as India?
The Indian market is quite hard to think about for a global investor because of all the capital controls in place. So we don't really look at Indian sovereign bonds. But more generally, fiscal deficits tend to be a concern for bond investors like us, but especially so where they don't have control of the printing press. So they're more of a concern in places like the Eurozone than they are in the places like the UK, the US, or indeed India.
Toby, what's your view on emerging market equities? Do you believe allocations are beginning to increase to this asset class?
In the last quarter of last year, there was a big outflow from emerging market equities, and most of that was actually brought back in the first quarter of this year, and that drove the performance. Since then, we've seen steadying flows, and we'd expect flows to be reasonably positive for the rest of the year, given that the greatest worries, if you like, are on the developed market side, and the risk premia in emerging market equities are quite attractive.
You do have India and China, which are the big stories in emerging markets. How are you approaching these two regions given the concerns of slowing growth that are playing out? What would be your tactical position on both these markets?
In the case of India, we see that, I mean, valuations are quite attractive for Indian history, but not that attractive on a global basis. But we're relatively neutrally positioned within our emerging market portfolios towards India. There's a fantastic structural story that we want to take advantage of, and we take advantage of through consumer plays within that Indian market. But they're not sufficiently attractive to pull us to an overweight position given the fiscal problems, the international balance of payments problems. But we are neutral there. On China, things are quite different, if you like. As you say, there have been concerns about slowing growth profile, and we've been anticipating that slowing growth profile also. Now, in the second half of the year, we see some of those growth pressures to ease as monetary and fiscal easing comes through, and so we're actually somewhat more positive than the market on China for those growth reasons. And the risks there, I guess, are on the property side, but also on the political side, but they're not sufficient to actually make us move away from that market.
Now, Toby, lastly, could the U.S. recovery in the second half of the year be the big surprise for 2012? Are you increasing allocations to the U.S. dollar, even U.S. equities and debt?
I think there's probably a number of questions there. In terms of could the second half return to growth in the US, or rather acceleration of growth, be a big surprise? It would actually be a surprise to us. We'd foreseen a stronger first half than second half, as some of the issues of the fiscal cliff came to pass. The US needs to tighten its fiscal deficit by around about 1.5% of GDP each year for the next 3 years, starting next year. And the degree to which that's going to impede investment is our principal focus when we're looking at US macroeconomics. That said, the US growth profile, it's not in a recession. We don't think it's going to go into a double-dip recession. We do see it moderating a little bit, but we're looking for the US to come out in a kind of a 2%-ish, 2.5% growth profile this year. That is to say, slightly less than the consensus, but slowing in the second half. In terms of what that means for the dollar and US equities, well, we're quite positive on US equities, but not because we have a strong out-of-consensus GDP view in the second half. We simply see that earnings are reasonable, valuations are not outlandish, and in a land of the blind, the one-eyed man is king, as it were. US equities do look reasonably attractive, although the degree to which that is becoming consensus is worrying. And on the dollar side, we like the US dollar, we're overweight the US dollar, and that's got more to do with our views as to the prospective quantitative easing that we think will not transpire over the next 3 months.
Toby Nangle, appreciate you taking the time out and joining in. A fairly optimistic view, expecting emerging markets to outperform the developed markets, and FII flows expected to be healthy for the rest of the year.